Hello, everyone. My name is Sean Adams. I want to thank you for taking some time to check out our website. I am the president here at Leverage Life Management, and I wanted to put together a quick video to introduce ourselves and our business and how we help our clients. So just for some background on myself, I spent the beginning of my career as an entrepreneur, owning several different small businesses. And I ultimately transitioned into a full account executive role working for multiple software companies. So I had a quota and I was managing an active pipeline for many years. So I want to tell you a little bit about my experience, see if this is something that resonates with you guys. So I found myself, after getting established and having my own processes in place for my sales profession, far exceeding my quota each and every month. And I, in turn, was making great commissions and great money. Each month I'd have chunks of money coming in, and not being a financial professional, not knowing much about investing, I wasn't sure what to do with my money. So I did what everybody else told me to do, which was to go and put my money into my 401k, contribute to what my company had in place. Sort of just like a sheep, I got in line and followed the path that everyone else was doing. A couple of years into that, I had this experience happen to me where our company switched HR providers, and therefore we switched the 401k provider or vendor that we were using. So we had this company webinar where the representative from the HR program sat us down, had 25 slides, perfectly nice person, but she rattled through all these different options and tried to give us an explanation about why it made sense to take advantage of the 401k. But what I found was, in all this information, it really left us with really just one option. And in that 401k, we were able to actually contribute to different funds, but it was nothing that we actually had full control over. There was just a series of small index funds or mutual fund groups that were blended together. And that was very confusing. And also, I just didn't know which one to pick. And they didn't really give us much insight into what or why we should pick a different one. So as I started to do my research, I'm thinking, wow, I'm the top producer at my company. I'm arguably making the largest commissions per month. And I don't feel comfortable just dropping my hard-earned money into any old type of fund without really understanding what's going on and why that might be the advantage. And as I started reading through the fine print and better understanding what the 401k was all about, I started to see that there was a lot of hidden fees. There's percentages and different fees that were going to accumulate over the course of my 401k over the next 30 years. And I started to realize that it was actually going to be counterproductive as the account grew. It's really going to be paying a lot to an organization just to allow me some of these things. So being entrepreneurial, of course, I had an issue with this. And there also was a lot of restrictions in place, which I'm sure you're aware of. The IRS and the 401k structure limits many different things, one of which is what we can contribute. So as of the time of this recording, it's $19,500 is the annual amount you can contribute to a 401k. In an IRA, it's something like $6,000 for an individual. And so this amount to me was kind of really challenging because I would have months where I might want to put in $10,000, $15,000, $20,000. And to be able to max out that 401k in 1 or 2 months was really frustrating for me because I wanted to actually have my money making more money, not just sitting in a savings account. I also had this real problem with the illiquid nature of these accounts because they were qualified, meaning we couldn't touch them until we were 59 and a half, 65, depending on the different structures of those accounts. And so I had a problem with that because if I wanted to do some sort of investing, if I wanted to leverage the money in that account, I would have to pay a penalty of up to 10% to remove any funds. I could take a loan, but it was very complicated. You could only do it one time. There's all sorts of different bells and whistles and things you had to go through. And I really was frustrated by all of that. So I decided I needed to do my own research before I put my money any more into these sort of traditional accounts. So what I ultimately did is I began reading books, podcasts. I started to do some interviews, listen to interviews, and I focused on 3 key areas. As I started to think about it, being entrepreneurial, I thought there's no way that the ultra rich people out there and these corporations are putting their millions and billions of dollars into 401ks or IRAs. There had to be other structures out there. There had to be other ways as I was becoming a higher earner where I could put my money. So I focused on 3 main groups. Banks, because it seemed like everybody had this banking concept in mind. the ultra wealthy individuals, so people that started, a startup organization that made a lot of money, or maybe a larger dynasty like a Rockefeller or the Carnegies, who've had money for well over 100 years. I wanted to understand how they passed money around. What organizations, what structures did they put in place? How did they actually put lump sums of money consistently to make sure they weren't, killing themselves, but also had access and weren't restricted in these different ways? So what I ultimately came up with was these 5 different levers of what an ideal sort of wealth vehicle would be for me. And those were: 1, guaranteed growth. So when I looked at the stock market, right, so I put money in my 401k, I don't have an issue with the stock market, but I do have an issue with all of my eggs being in that one basket, a basket that is very turbulent and moves up and down every minute of every day, and is very stressful when you have your hard-earned dollars sitting in there. And while, yes, over time it does traditionally have a positive return, that compounding growth does not keep into effect if there are those down years. We do lose a lot of effort, and we're sort of rolling the dice on our retirement if we end up retiring in one of those years where it's down. And so I really didn't like that. I wanted something guaranteed. I was perfectly comfortable taking a lower growth percentage if I could get some sort of level of guarantee or close to it. I also wanted something that had a tax advantage to it, right? So that meaning I wanted to be able to contribute to something. I was okay paying after tax dollars into an account, as long as I didn't have to pay additional taxes on that. And if I did, if it could be structured in a way that could limit or have some sort of deferring of those taxes. So I knew that the ultra wealthy were very focused on saving and tax harboring and sheltering. And I wanted to understand that, because as I make more and more money, those tax bills get higher and higher. And I want to be able to leverage a system that helps me to protect against those taxes. Now, similar to guaranteed growth, I also wanted something that was non-correlated. And by non-correlated, I mean not linked to the stock market. So it's perfectly okay to have some of my money in the stock market, or play around with different stocks and have sort of disposable income in there. But I didn't want all of my lump sum, my nest egg, my sort of warehouse of wealth that you'll see we call this, all in something that would go with the tide and the ships and the ups and downs of the stock market. I also wanted something that had liquidity, meaning I could access the money whenever I wanted, not at a certain age, but at any time, and I was not going to be penalized to use my own funds. And lastly, I wanted some level of protection. All the decisions I was making were just with this assumption that I was going to be making, 6 figures and beyond for the next 30 years. And while that hopefully is the case, there's also an option where I could get disabled, I could get sick, or even pass away, and my family would not have the ability to continue to make that money into the future. And so I wanted to have some protections in place to make sure that they would be taken care of if my income was not being able to be produced by myself. So as I looked through all these different processes and the different structures, I found that banking seemed to be this common thread that was coming up with the ultra wealthy individuals, these corporate, Fortune 500 companies, as well as these families, these dynasty families. So I decided I needed to learn, 1, how the wealthy looked at these organizations. How do they use banks, or how do they build their own sort of banks? I heard this sort of private banking comment come up. And also how, they were really leveraging what was considered other people's money. So I learned that banks really were the ones that pioneered this concept of leveraging someone else's funds to make a profit and return that capital, but also keep and hold their own sort of percentage of that growth. And as I looked at banks, and specifically the ones that were stock traded, if you look at open or publicly traded companies, you can actually look at their balance sheets and you can see, and on their asset column, one of the largest things that banks own, or the tier 1 assets, are actually high cash value life insurance, of all things. I thought that was super interesting. And I was trying to understand where banks put their money. What do they invest in? Where they put these big lump sums? So it got me on this quest to actually break down the banking concept. And just for context here, I'm not a financial advisor. I'm not a tax consultant in any way. I'm simply giving you my experience here and what's helped my clients, and my experience in how the banking system works. So ultimately, us as an individual, we have our funds. We drop that money into a bank. Right? What does the bank do with that money? Well, the bank ultimately takes our funds, a portion of them, they pool them with all other funds that they have in their bank, all those other deposits, and they, believe it or not, purchase life insurance because cash that's in their accounts is actually an asset. Therefore, they can insure that asset. So they take out, using insurance companies, life insurance policies on that cash, the cash value in those accounts, that provide all these different trickle-down benefits that the bank gets to receive. So one of those things, aside from growing a cash value that kind of sits inside these, call them savings accounts, these cash value life insurance policies, the insurance company actually pays a consistent interest rate, a guaranteed interest rate back to the bank. Now, typically that fluctuates between 4 and 6%, 4% on the very, very bottom, up to 6 or 7%, depending on the organization. And the insurance company will actually pay the bank that insurance, that percentage of the insurance premiums, which come in the form of interest. So ultimately, the bank pulls all of that money, your money, buys a policy with it. Think of it like an investment. That investment spits back 4% to them as a customer. They get to recoup all of that themselves. And what do they do in return? They kick back a very teeny tiny percentage back to us, the customer. Usually it's 0.1% or some terrible number that you would have to save for 10,000 years and you still wouldn't have enough money in the bank. And so this structure made me think that, wow, if banks are making 4% to 6% of my money, why am I giving them this, right? And in turn, they say, oh, well, we give you protection, we give you a checking account, we give you the ability to, have a debit card and do all these things. And so I just found it really frustrating that there was a middleman to this scenario and they were benefiting from using my money. And if you don't think this is the case or you don't believe me, if you have more than, say, $15,000 in any bank account, go down to your bank and try to withdraw it all in cash right now. 9 times out of 10, you'll find out that the bank will tell you, oh, sorry, we actually don't have that much cash available here, right? So that means that the money you're seeing on that screen on your app is just a number because they're using it elsewhere. They don't actually house that money here in the bank. And so that concept is what fuels our economy and what actually allows banks to make money. So my thought was, how can I actually leverage this principle, all my 5 wealth levers or the characteristics that I was looking for in a strategy, how can I actually make that for myself instead of having to rely on a bank to do this or rely on something like a 401k that doesn't have next to any of these levers available? So ultimately, I worked with many different providers and advisors and developed my own strategy, and now one that we put together for our clients as well. And it's all about eliminating the bank. Now, I am not saying that we should take all our money out of the bank and store it in our mattress or in the walls. I'm talking about long-term savings, long-term strategies for our money. So still keeping a checking account and having all the normal day-to-day functions of finance. But I'm talking about your larger purchases, your savings, all those strategies. Instead of having everything into a bank or a 401k or an IRA, how can we alleviate that and leverage this principle that the banks are using with high cash value life insurance? So ultimately, we're leaving the bank or the middleman out of it, and we're connecting us as the client or a policyholder to the insurance company. So instead of the bank getting this 4 to 6% return on our money, we're going to get that 4 to 6% return on our money, in addition to all these other benefits that cash value life insurance provides for us. So the way that our structure works, our wealth accounts are actually designed very, very specifically, and they allow for basically 2 core components. And these are the core components of any life insurance policy, particularly whole life insurance, not in the term sense, but we won't get in the details here. One, there's a death benefit, and the death benefit is simply that, right? So if you, the insured, passes away, you can actually assign a death benefit, and that's what your premiums, the money you spend into a policy, afford you a specific death benefit. And you can set that death benefit whatever you want. You just have to pay a premium that buys you that death benefit. And all that means is when you pass away, you're going to leave a death benefit or that amount of money that you purchased to a beneficiary. That could be a child, a spouse, a partner, whoever you want to leave as the beneficiary of that death benefit. And the second component is what you might consider a living benefit, which is really the cash value. So our structure actually allows you to overfund these life insurance policies to maximize the cash value of the account so you can actually use that cash value as an asset, just like the banks do. So you have this cash value that gives you many, many advantages that we'll kind of cover here really quickly. So our policies are designed to be able to overfund them so that we can maximize that cash. So what does the cash value do for us? Well, going back to our levers, it gives us all of these things in one spot. So guaranteed growth. Our insurance companies have a guaranteed floor or interest rate, typically 4%. So that's the interest rate. There's also a dividend. Dividends are not guaranteed, but the companies we work with have successfully returned a dividend on top of that 4%, usually in the terms of about 1 to 2% in a dividend, successfully for well over 150 plus years, right? So every single year, even through the stock market breakdown of 1929, through the 80s savings and loan, through the dot-com bust, and of course, '08, and now even the pandemic, these companies have successfully returned a 4% minimum and up to 6 or 7%, or 1 or 2% additional in dividends as well. So that's guaranteed growth. We talked about cash or tax advantages. The principal here is not taxable, right? So the contribution we're making into a life insurance policy is used with after-tax dollars. So after we've already collected our commission check or our money that we've received in our W-2 income or whatever that looks like from our business, we are not taxed on what we put into these accounts, but the gains or the interest that grows on that account is actually taxable, but only if we withdraw that amount of money. So very similar to your qualified accounts. So if you were to withdraw that, the only thing you're going to be taxed on is the interest that was gained through using one of these policies. But the way that we structure these things are so you don't have to withdraw, therefore you're not going to have to pay the taxes on that if done correctly. Going back to non-correlated, again, we work with what are called mutual insurance companies. These are firms that are owned by the policyholders, not stock companies. So stock companies are going to be on the stock exchange. These are public companies that are owned by stockholders, not necessarily policyholders. So this means that their value or what they contribute has to all go to the profit. That's their central focus as a stock company, and which means they can kind of bypass policyholders and anything else that they want. It's all for what's going to look good on the annual report that's going to go out to their stockholders. We don't want one of those companies. We want a mutual company that's going to allow us to not fluctuate with the ebbs and flows of the market. It's going to consistently and guarantee our results from a tax perspective as well as that growth perspective. Liquidity. All right, so this is another huge one here. Our cash value is liquid and it's available to be loaned out against anytime we want with no penalty. So what that means is very similar to how equity works in your home. As you overfund this policy, that cash value is going to grow. That cash value, think of it like equity in a home. You can actually take a loan out against that equity that you built in anytime you want. And it's all what's called self-collateralized. And all that means is the insurance company goes, look, let's say you have $100,000 in a policy in cash value. And let's say that you want to take out $50,000 to go purchase a car, to go purchase another home, down payment on something, whatever. It's the exact same principle as if you were to have a $100,000 equity built into a home, and you wanted to take a HELOC or a home equity line of credit. The bank will give you a loan based on the equity you have built into your home. Same exact idea here. The insurance company will loan you out your money or a value up to the amount of money you have in that account for you to do whatever you want with. The difference is you actually set the terms of payback, if at all. And what I mean by that is it is collateralized by the amount of money in this account. So what that means is if you decide you're not going to pay this loan back, so if $100,000, you take $50,000 out to go purchase another property, and then you just say, you know what, I don't want to pay back that loan, that's perfectly okay. There is a simple interest that the insurance company will charge you every year, very simply, it's typically 5 or 6% for loaning out that money, but you don't have to pay that back. So the interest will continue to grow if you don't pay it back, but there's no penalty, it doesn't go in your credit report. It's all a private contract between you and the insurance company. And so if you do not pay that back and it goes and you pass away at 85 years old, that death benefit is going to go to your beneficiaries. And what it's going to do is they're going to remove or take out the loan difference. So if you had that $50,000 and it grew over 30 years, maybe there's 15% or $15,000 in interest. They're going to say, okay, we're going to take the $65,000 you owe us. We're going to take that right off the top of the death benefit. And that's how they're going to go and collateralize, or just like if you were to go to the pawn shop and you have a $10,000 Lexus or a Rolex, and you want to go and get a loan for $8,000. They hold the cash, or in this case, the Rolex, the watch, sort of hostage for you while they loan the money. And if that person disappears and never comes back, the pawn shop owns that watch now, and they can sell it for a profit. Same exact idea. And lastly, we talked about protection, right? So at the end of the day, we are purchasing life insurance. And what that does is it secures us a death benefit and a safety net for our family. So at any point, if we were to pass away, we have that protection in place for our family, for that cash value or that death benefit that's going to go to our family, just in case we are not in the picture anymore. And lastly, life insurance is also, in most states, protected from litigation, bankruptcies, divorce, or creditors. So if you get into some scenario, the money, that contract you have with you and your life insurance company is private. It's not listed. You don't have to put it on your tax returns, anything like that. It is all something that will not be accessible in most states through any of these sort of litigations that might happen. So the death benefit and the cash value is super powerful, right? So I know we just jammed a whole lot into what was about 20 minutes here today. I just wanted to thank you guys for taking a couple minutes to look through all that. I hope you see the advantages in what can happen with our leveraged wealth accounts that we're talking about here. And so usually at this point, it's a whole lot of information. There's a lot of complexity that goes into these things. We specialize in helping customers to sort of understand how these things are applicable to their scenario. And we find that at this point in the conversation, people usually fall into kind of two camps. One, you're interested, but you want to do your own research. You don't want to be pressured. You want to kind of do your own looking into and understanding these concepts. So we put a link to a longer, more in-depth, it's about an hour recording below this video where we go in-depth in these concepts. You can look through our website. We have blog posts. We have videos. You can check out other providers. We also have some links to some good books. We did not write these books. We just recommend them. And these are people that you can actually learn a lot from. So we highly encourage you to reach out to us if you have specific questions, but do your own research. It's no pressure at all. We want to make sure you're fully educated going into this scenario. Or if you're reading through this and you're going, okay, this all makes sense. I'd like to learn a little bit more, but I have a pretty unique scenario, and I'm not really sure if this is going to be something that works for me. I wonder if we could talk through what these things would look like. So the best next step in that case is to book a call with me. I have a link below on my calendar. You'll get a pre-call questionnaire just to fill out your background information. It'll be a no questions asked, no hard sell here. We're just going to talk through in a conversation over a 60-minute session, and we will learn more about your situation. We'll actually make some recommendations as well. You'll talk one-on-one with myself, and we'll figure out if and what type of policy would be a good fit for you. And we'll map that out, and of course, we'll go through, what that would look like, the costs associated with that, et cetera. So in case you might be interested in moving forward, and so just so you understand how this process works, we would have that first intro call. We would then have a second call where we'd structure out or tee up that policy design so you could take a look and make sure everything looks okay. And then we have the underwriting component. Now, remember, this is insurance, which means we have to have the insurance provider's underwriting approval. And so that will be an application you'll submit that'll have your medical records and your personal information. The underwriter will look at the policy design and the application, and they will hopefully approve you for this particular plan that we're going to put in place. There might be some tweaks and things like that. That's what we're going to be there for, to help you with, to put in place. And ultimately, once we get that approval from the insurance company, then you're live. Now you have that plan, and we need to help you implement it. So we will actually walk you through how you're going to fund your account, how you can add those excess funds, and what it looks like to kind of work your plan moving forward. So that should be a good kind of snapshot of the 4 steps it takes to kind of go through this process. I hope that was helpful. I thank you guys for taking some time to walk through this video. If you have any questions, please browse our site. Don't hesitate to reach out. Thanks so much.